Friday was the biggest travel day of 2022, and for many, it was another travel nightmare. Hundreds of delays and cancellations, passengers stranded, vacations ruined. At Boston's Logan Airport, delayed travelers were left to take naps on the airport floor.
We had people that were in front of us and behind us trying to rebook, and they had no options either.
What was once a rare occurrence is starting to become the norm. The airlines blame pilot staffing shortages, coupled with an unprecedented number of Americans flying. Add to it the bad weather this week, and you've got a perfect storm.
We love today, Vanessa.
Oh my goodness, Cindy, this is the type of weather that I just dream about. The air is dry, temperatures will be in the 70s, and we are going to enjoy a lot of sunshine.
Transportation Secretary Pete Buttigieg met with airline CEOs this week to urge them to improve service, tweeting, "Air travelers should be able to expect reliable service." Delta pilots published an open letter to passengers blaming management, saying, "We've been working on our days off, flying a record amount of overtime to help you get to your destination."
My first flight was delayed more than 2 hours.
Experts say it could be months before staffing shortages improve, meaning your summer travel plans may be at the mercy of the airlines.
The reason I'm taking this flight is to present at a conference, and if I don't make it the day I was supposed to arrive, I might not be able to present.
Meanwhile,
All right. Today is Wednesday, June 22nd, and this is a recap for the stock market activities today. Folks, I got a good one for you tonight, but it's been a while since we talked last time, so let's catch up. First, I hope you enjoyed the long holiday and you were not one of those people stuck at the airports. Happy Juneteenth, by the way. Happy Father's Day. AKA Happy New Tie that I'm never going to wear in my life day. But you know what really bothers me about Father's Day? Everyone on social media claims that they got the best father ever. Meanwhile, the dads are like, if I'm the best daddy ever, then how come I only hear from you once a year? And the conversation usually evolves from, "Hi Dad, how you doing?" to, "So Dad, I'm going to need a little bit of money." And you know, since everybody claims that they got the best daddy ever, I'd like to settle that claim. We need to start a tradition here, like the dog show on Thanksgiving. Every Father's Day, the WWE should air a special where all of these dads get in a cage match against each other, smacking skulls with steel chairs, and let's see who ends up lasting. And we crown that dad with the title of the best dad ever. Otherwise, it's confusing. How else would I know if your daddy is indeed the best daddy ever, if he doesn't smash the skulls of the other daddies that they claim that they're best daddies ever in a cage match at the WWE? But you know what? Not every daddy had a good Father Day. For example, the richest man on the planet, Reverend Elon Musk, did not have a good one. Oh yeah. His son decided to come out and become a she. And no, we're not talking about Xi Jinping. That would have made Elon Musk happy, but we're talking she as in gender, she. Then she disavowed her father entirely. Goodbye. Wait till his next kid comes out as a Martian. Anyways, you know what else? Oh yeah. President Joey B. over the weekend, you know, since everybody's now talking about how weak and demented he is, a genius staffer thought it was a good idea to show the world how vital Joe Biden is by putting him on a bike over the weekend. And this is how it went.
Dr. Biden, how was it?
Yeah, let's put an 80 years old on a bike and see what happens. Wow. But rest assured, while Joe Biden could not spin, the media did the spinning for him. Anyhow, folks, we got a lot to talk about today, from the chaos at the airports over the weekend to the chaos in the tulip market, aka cryptos, to market indicators that the dip that you're seeing right now will keep on dipping. So let's not waste any more time, and here it is. In focus tonight, Vengeance is coming. You heard that right, but before we talk about vengeance, let's talk about the chaos that we got in the airports over the weekend. And this is becoming a consistent theme, by the way. Over 35,000 flights over the weekend were canceled. We're seeing this theme continuing. You have no idea whether you're going to have a flight or not. You buy the ticket, you get to the airport, early of course, and you find out that your flight is delayed, and then finally you get the text that the flight is canceled altogether. Meanwhile, you've been waiting and stuck at the airport for hours. And by the way, the food sucks at the airport. Now, why are we seeing this phenomenon? The answer is clear and simple. We have an insane surge in demand, while the supply is nowhere to be found. Matter of fact, demand for domestic airline flights has already surpassed the pre-thing level, and that is despite the costs. You're paying an arm and a leg for a ticket, and then you get your flight canceled anyways. The Fed, of course, initiated the cocaine operation in response to the Great Panic in 2020, and that created inflation and induced unnecessary demand in the economy, excess demand in the economy. Meanwhile, that created a lack of supply, pressure in supply, and there is no supply chain system in the world that can cope with this level of demand. We're seeing staff shortages all over the place. Your summer holidays might be ruined, so watch out for that. And it's going to take 12 months before the situation gets better. But it doesn't get better for the staff working right now in airlines. The flight attendants, the pilots, the mechanics, etc. They're facing demanding customers, disrespectful customers, and they're getting paid nothing when you pin it to this inflation. So we have workers dissatisfied. I know a lot of air flight attendants in my friends' network, and they're not working. They're not coming back. They're actually working part-time when it works with their schedule, when they need the money. But that's about it. And of course, the pilots published a letter to us consumers over the weekend, pointing out that the demand is out of whack and it is impossible to cope up with this level of demand. We've been working on our days off, flying a record amount of overtime to help you get to your destination, the letter states. At the current rate, by this fall, our pilots will have flown more overtime in 2022 than in the entirety of 2018 and 2019 combined, our busiest years to date. Insane amount of demand. The supply is nowhere to be found. We're not going to print 3D pilots. We need the pilots. Where did the pilots go? Because it's not just airlines. The airports are suffering from staff shortages, and they're rushing to recover the jobs they cut during the pandemic. Airlines are so desperate, matter of fact, they're actually recruiting non-experienced pilots and cutting requirements for training hours, for example, to get these pilots to fly sooner. Now, what could go wrong, right? You have an inexperienced pilot with very little training flying planes all over the country. Anyways, it's not just pilots, it is air traffic controllers, for example. The shocking reality is when you're flying at night, there is nobody there. There are no air traffic controllers. Good luck to you. And now the airlines are saying, hey, airports, and the United States for that matter, must ensure that we have adequate traffic control so we can meet demand. Otherwise, this is a recipe for a disaster to happen. Any mistake, any slip, we could see a disaster that will be in the top headline news. But rest assured, your incompetent Transportation Secretary, Pete Buttigieg, whatever his name is, well, he has the fix. And the fix is he's going to bark at the airlines on your behalf, on the consumer's behalf. Hey, airlines, get it together already. Get these customers to their destinations because we need votes in November. What's wrong with you? Meanwhile, the airlines are like, flight attendants? Pilots? Anybody? Or should the planes just fly themselves, Mr. Buttigieg? And of course, all of this was predictable, folks. It was not a surprise. This channel last year said that the jab mandates will be disastrous, will be a stagflation disaster. And guess what? YouTube demonetized that video. A lot of you, not you, the good viewers, but the bad viewers, were saying, unsubscribe, but what do you know about science? Stick to the stock market. Well, now you know I'm right. Are you going to apologize? Are you going to say, hey, bro, you were right all along? Of course not, because it's all about ego and control. We said that these mandates will push pilots and staff to retire early, and they will push a lot of staff, other staff, to just not work for the industry altogether, to take time off. And the pilots been warning over and over and over again that this would be a disaster. They pushed back against the mandates, October 2021. The mandate is the destruction. Pilots fighting the mandates and uniting with airline workers, saying, hey, this is irrational. This is going to backfire. And nobody listened, of course. Pilots, once again, warning that the mandate could cause holiday travel chaos. And we're seeing the chaos right now. Unions, pilot unions, have been warning that this is a dangerous situation. Pilots should be focused on flying, not federal jab mandates. Southwest airline pilots, for example, made it clear that they want to block the jab mandates. Of course, Southwest Airlines did not listen. They listened after the fact, too late, and then you have other airlines who were threatening employees and pilots of losing their jobs. Hundreds of employees. United Airlines been warning hundreds of employees, either take the jab or goodbye. Well, a lot of folks chose the goodbye route. United Airlines fired 6 pilots for refusing to take the jab. Again, what could go wrong? And they were draconian and so tyrannic in their approach. They blocked any pilots, any attendants from finding other jobs or accessing their 401ks for refusing the jab. And you wonder why we're seeing a backlash from pilots who decided to retire? And they're never coming back? The staff, the pilots that you humiliated and threatened with homelessness and job destruction, career destruction, income loss for not complying. And you wonder why we have a shortage of pilots in the country and we're seeing all of this chaos at the airports. And of course, airline stocks are suffering because stocks have the tendency of looking forward. And when they look forward, they see a disaster for the airlines industry. For now, with inflation, they have the ability to pass the extra cost of higher wages, jet fuel costs to the end consumer. But that's not going to last. What if the consumer weakens? And that will happen because the Fed is increasing interest rates. The Fed is tackling demand in the economy. They have no control over supply, theoretically speaking, of course. So they have to crush the demand. Will these airlines even survive with higher jet fuel costs, higher salaries, and oh, by the way, waning demand by the consumer? Thus, their ability to pass the extra cost to them is now diminished. Watch out here. Next, let's talk about the crypto chaos. The chaos was not just in the airports over the weekend. It was also in the tulip market because Bitcoin plunged below $20,000 for the first time since December 2020. But rest assured, you got crypto pumper Kevin O'Leary who says he will not sell any crypto despite the downturn, and you just have to stomach it. Well, you better buy a lot of Pepto-Bismol because with all of that stomaching, there's going to be a lot of shitting. And it's not just Kevin O'Leary. Remember Miami Coin, the Ponzi scheme of Miami Coin? Well, if being creepy did not scare you away to begin with, the mayor of Miami has those used car salesman vibes. And he has an advice for you. If you're suffering, if you're losing your tulip mind, he got some advice for you. Take a listen.
These technologies are extremely new, and so, they're always speculative, right? And so, one of the things I've always said is, look, you should never invest money on something that you don't A, believe in, or B, there is a possibility you could lose that money, so it's got to be money that you're willing to sort of invest in that way.
Yeah, you have to be okay investing your money that way, the way of flushing your money down the toilet that way, because it's new technology. It can go up, it can go down, we never know. But we're done with the Ponzi scheme of Miami Coin. We raised $5 million, who knows where that money even went. And all of you investors, well, good luck. Just be okay with investing that way. And of course, there is a liquidity crisis in the tulip market. And it is becoming contagious not just for other cryptos, but also for the equities market. That is the risk, by the way. When people talk about the hidden accelerator that could morph a correction or a bear market into a crash in the equities market, well, could margin calls in the crypto market be that catalyst? Because in the morning today, I've been listening to a podcast with other crypto maniacs, and they've been talking about the liquidity crisis in cryptos. And apparently, you have these holders, these big-time holders, the whales, who've been holding Bitcoin, for example, for a long time, since Bitcoin was at $500, for example. And what they do is they lend these shares to other lenders who lend them to other lenders, to other lenders, to other lenders. And at some point in that chain, there's going to be a weak link that's going to break. And when that breaks, game over. I mean, it sounds like the housing market back in 2008, right? With all of that bundling of loans and mortgages. What could go wrong? And in the crypto market, what could go wrong when you're bundling a bunch of tulips that somebody else owns and you keep lending that over and over and over and over again? But it's not just the liquidity crisis here. We have Celsius, who's already falling apart, and investors cannot get their money back. They cannot even access their money. You have other lenders, such as Babel, who are freezing withdrawals. All of a sudden, you have these tulip investors who are trying to log in, who are trying to get out, perhaps sell their assets before they go down further, and they realize that they cannot even withdraw the money. Their accounts are frozen, and that was part of the fine print when they invested in these things. But of course, the hammer is coming down. The South Korean authorities are now banning the folks involved in the Terraform, the Terra Luna disaster from leaving the country, meaning prosecution is coming. I trusted them with my savings. Crypto investors scramble after accounts frozen. It's horrible. It's an absolute disaster. And a lot of folks are suffering from all of this. And of course, this is going to be contagious, folks. It's it's not just going to be limited on Bitcoin or Ether or Rocket or Titcoin or any of that garbage. It's going to be contagious to the equities market too, because a lot of folks took insane margin to buy cryptos. Now they have a stock portfolio that has to be liquidated if the margin calls hit. And that is one risk that nobody's paying attention to. But rest assured, you got the billionaires, the pumpers, continuing to pump. In this case, Elon Musk continuing to pump. His pyramid scheme, the con man, continues to pump. And oh, by the way, he's throwing in, some merchandise that you can buy using your Doge that is worthless right now. You can buy some Tesla merchandise, hats, bumper stickers, and the likes. So congratulations. And remember Mark Cuban? Mark Cuban used to be the poster boy of the dot-com bubble, the guy who got away with it because he outsmarted all of these morons back in the dot-com bubble. He sold his company, which was worthless to begin with, and I mean that in a bad way. It was trash. He sold it to Yahoo. Yahoo overpaid for that. He understood all of that dynamic that we are in a bubble. He cashed in, and he ended up being one of the few winners from the dot-com bubble. So you would think that this guy understands bubbles and these pyramid schemes, but no. When it came to the GameStop mania, the meme stock mania, and crypto mania, Mark Cuban was on the bandwagon, cheerleading and egging young investors to continue with the stupidity of investing in meme stocks and cryptos, worthless cryptos, by the way. And we're now finding it's not just the retail mom and pops who are investing in cryptos. Nearly 30% of billionaires are either directly or indirectly involved or invested in cryptocurrencies. And this is a rate that is higher than non-billionaire investors. Now, when billionaires start investing like a bunch of morons, what could go wrong? Well, we have examples. 2008, the great financial crisis, the dot-com bubble, and the list goes on and on. But when that was happening, the mania, instead of pointing that out, like this channel did, for example, and we caught a lot of shit for it, by the way, I could have chosen the route of saying, listen, meme stock investors, that's a huge chunk, and I'm looking to grow the channel. I'm looking to make more money. I could have chosen the path of catering to the apes and the meme stock maniacs, the crypto maniacs, but I chose not to do so because I knew how this movie would end. Mark Cuban has to have known that even better than me because he was involved in the dot-com bubble. But no, he went on and said, I got to say I love what's going on with Wall Street bets. All of those years of high-frequency traders, front-running retail traders, now speed and density of information in retail trading is giving the little guy an edge. Oh, really? Even my 11-year-old traded with them and made cash. Yeah, your 11-year-old who's set for life because daddy got cash. But the rest of the apes, they don't got rich daddies. Happy Father's Day, by the way. But here's what Mark Cuban said back amidst the heat of that mania, the meme stock mania, the crypto mania. He pointed out that valuations don't matter anymore. And he shit on Dodd-Frank, for example. Take a listen.
And I think younger kids, Gen Z in particular, maybe younger millennials, have a different approach to how they look at stores of value, how they look at how assets are priced than we looked at traditionally. And let me just add, look, the narratives that we create to sell stocks, price earnings, right, discounted cash flow, those are all subjective. We just have been told by Wall Street that if the lower the price earnings ratio against your growth rate, then that's an indicator that the stock's going to do great things. Or Graham and Dodd in terms of asset valuation. And, that doesn't necessarily hold in a digital environment in the same way it did in the past.
Now, fast forward, and here's Mark Cuban. He says crypto crash highlights Warren Buffett's wisdom. Oh, really? This is the same guy last year who was shitting on Dodd-Frank, the timeless investing guide that inspired Warren Buffett, by the way. There was a certain set of timeless investing principles. One of them is buy cheap, sell expensive. But that comes with a catch, which is the appreciation of the value of that particular asset or lack thereof. Meaning, is there intrinsic value that will grow years from now if you buy the asset at this point? And if that is the case, then it is a smart investment. But when you have assets like meme stocks and cryptos with no intrinsic value at all, it becomes what the Philippines' incoming central bank chief described as the greater fool theory, which means I buy now because the fool right next to me is willing to pay more the very next day. And that becomes the greater fool theory, a pyramid scheme, passing the buck until the greater fool ends up being the one holding the bag by the end. And in this case, the greater fool happens to be the mom and pop investors, unfortunately, of course. But rest assured, one of the top crypto pumpers, drunk Michael Saylor, has the solution for all of this crypto crash, chaos, Michael Saylor urges governments to step in and regulate crypto's parade of horribles. Oh, really? This is the same libertarian who says government is bad. All of a sudden, please, government, step in and bail our asses out. Typical billionaire would say, enjoy it while it lasts, Mr. Saylor, because it's not gonna. Now, let's move on to market technicals and the vengeance part, because last week was ugly across the board. Everything was down. Stocks, bonds, high yield, commodities, investment grade bonds, everything was down. So what's going on here? But stocks with more buybacks, stocks under buybacks, aka catching a falling knife, happen to be outperforming stocks with no buybacks. So there you go. If you want to muff the pain, stick with the buyback stocks. Because Goldman Sachs says that their buyback disk was flooded with orders during the stock rout last week. A lot of folks are pointing to this as a sign of a bottom because the corporates are buying back their stocks. I wouldn't put a lot of stock on it, to be honest. While valuations are down significantly from the top, for example, the S&P 500 best PE ratio is down right around the average. So is this a buying opportunity? Here's the problem. The denominator is the earnings part. What if earnings come out disappointing? Then the answer becomes we have more trimming to do. We have more pain to feel. Yes, valuations are down. Price to earnings ratios have collapsed in the fastest, most rapid way in history. Never before we've seen valuations being compressed so fast. So again, is this a dip buying opportunity? Well, be careful here because, historically speaking, bear markets last for hundreds of days, if not thousands of days. For example, the dot-com bear market lasted for 1,165 days for a recovery to happen. The great financial crisis took 1,009 days before a recovery, while the shortest bear market recovery took place in 2020 during the Great Panic. It took only 103 days for the stock market to recover, but we all know the reason. The greatest unleash of liquidity in human history. The cocaine operation. This time around, the Fed doesn't have the room to unleash another cocaine operation to stimulate the economy. Quite the contrary. They have the opposite problem. They have to tighten the monetary policy because we now have inflation. And once again, historically speaking, bear markets usually trim valuations by about 50%. In the aftermath of the dot-com, for example, valuations went down by 49% before bottoming. In the great financial crisis, valuations went down by 42% before a recovery happened. We're now down at around 26% in valuations. So if history is right, we have a long way to go. Furthermore, remember Tina? Well, Tina is dead, just like Zed, since we're talking about Pulp Fiction, right? Because the 10-year yield now exceeds the dividend yield from the S&P 500 by a lot. Matter of fact, the widest margin since 2011. So, would you rather take the risk in the S&P 500 when the 10-year is paying you higher dividend risk-free? I'd take the risk-free for now, and therefore the stock market is not attractive as it used to be, even though valuations are down. Likewise, while the stock market went down, the so-called analysts' expectations and forecasts for earnings have yet to be adjusted. So when we talk about the PE ratios going down and correcting, well, there is a catch. Earnings estimates have yet to be corrected, which means we have more trimming in valuations to come. On top of that, according to Bank of America, when they talk to fund managers and ask them, how many of you say global profits will improve? This is the weakest reading since the crash of Lehman Brothers. So the fund managers are saying, forget about profits. Profits are going to be the weakest since the Lehman era. And if that wasn't enough, here's the blended forward EPS in red, which historically speaking acted as incredible. Bottoming point, support point, whatever you want to call it. We still have a long way to go in the S&P 500 before we get to that line, that blended forward EPS. And I hate to pile up on you, dip buyers, but look at the correlation between the Fed balance sheet and the NASDAQ, for example. As the Fed balance sheet expanded dramatically under the cocaine operation, unleashing the biggest tsunami of liquidity in human history, the NASDAQ shot up higher. Now, the NASDAQ is falling apart as we see the Fed balance sheet contracting. But here's the catch. They haven't even started yet. They have a long way to go in trimming the balance sheet, which means perhaps we have a long way to go in the pain journey in the NASDAQ. So be careful here, not to get sucked in these bear market rallies and these traps. And here's the last chart. Unlike 2009, for example, and the aftermath of the dot-com bubble, unlike these bear markets, which came hand in hand with a recession, with a collapse in the CPI on inflation. This time around, we're seeing a bear market under stagflation as inflation continues to rise. We haven't seen this dynamic since the 1970s. So one could argue that we are indeed in uncharted territory because the assumption is we have a bear market, we have inflation cooling down, and in this case, that would solve a lot of our problems. But the catch is, if inflation goes down, as I've talked in the video that I produced earlier today, if inflation cools down, that would not be for the good reasons, meaning supply is catching up with demand, or demand falling down to the sweet spot. It would be because things are falling apart and we're heading into a recession. And the assumption for now is the Fed is going to increase interest rates until a point when the recession becomes clear. And then, to revive the economy, they're going to start cutting interest rates again, assuming that inflation went away. And therefore, a lot of folks are piling in, buying these bonds at these higher rates to lock in a risk-free rate that we haven't seen in quite a long time. For example, in Australia, a single buyer snapped up all $1 billion in bonds in one auction. And by the way, I already shared this with you. I'm allocating some of my assets, some of my cash, because I'm dumping stocks like I'm with Pepto-Bismol. And I'm using some of that cash to buy the 6-month note, the 3-month note. Again, not a long-term commitment, but I'm locking in a decent rate, a risk-free rate for a short amount of time until the chaos in the stock market is gone. And who knows how long will that last? So why not go to the safety of bonds for now, specifically the short-end notes? And of course, with all of what's going on, JP Morgan economists, with exception of Marko Kokoranovic,
what a stupid son of a bitch,
are revoking God and Samuel Jackson in a chilling research note about central banks. What are they talking about? Here it is. JP Morgan's Global Economic Research Team just published a note titled, "They will know I'm the Lord when I lay my vengeance on them." The quote comes from Ezekiel 25:17. It was popularized in Pulp Fiction by fictional hitman Jules Winfield, portrayed by Sam Jackson, who would recite the verse before dispatching his marks. Why are they drawing this analogy of Jules with Ezekiel and the central bank? Here it is. Led by Bruce Kaufman, JP Morgan's economics team employs the chilling language to characterize the Federal Reserve's decisively hawkish shift in the wake of recent hotter-than-expected inflation reports. Matter of fact, hedge funds are now expecting a nightmare scenario where stocks could drop 50%. Why? Because the Fed will lay their vengeance upon us. They have no other choice at this point but to do so. Why? Because they're too late to the game. They're way behind the curve. They're playing catch-up. A lot of things could go wrong when the Federal Reserve becomes aggressive all of a sudden. That is because the Fed is just now getting aggressive in tightening financial conditions as data begins to show a slowdown in inflation. Really? What data? That scenario can cause significant policy whiplash that leads to economic hardship for millions, according to Cicchini, whoever that is. Stifling domestic demand with too late rate hikes could now result in a prolonged recession. Case in point, look at what's going on at the airports. Demand is out of control. The Fed has no other choice but to crush that demand because they cannot print 3D pilots, for example. When you crush that demand by increasing interest rates dramatically, you gotta fine-tune it to the sweet spot. Nobody knows where the sweet spot is because there is a lag between the Fed's action and where it takes impact on the economy. So good luck to all of us. And here's Cicchini saying the same thing, especially because policy works with a 3 to 9 month lag on the economy, adding that the Fed's stubbornness to wait so long to raise interest rates could lead to a costly policy whipsaw. That is why it would have paid dividends for the Fed to rein in consumer demand by kicking off its interest rate hike cycle earlier than it did. Surprise, surprise. As that would have helped tame demand before supply chain constraints and higher oil prices added fuel to the fire. Instead, the Fed is embarking on a fast and furious interest rate hike path that will likely include 2 back-to-back 75 basis point interest rate hikes in July, which followed a 25 basis point and a 50 basis point interest rate hike in March and May, respectively. In late 2021, the Fed had only expected to raise interest rates once in 2022. How things change. Unfortunately, the risk-off scenario we articulated in late 2021 is beginning to play out. will play out, And the 1970s drawdown scenario of almost 50% for the S&P 500 is becoming all the more likely, Cicchini said. A 50% decline in the S&P 500 from its January peak would send the index down to 2,400, representing potential downside of more than 30% from current levels. So buckle up your seatbelts and grab the popcorn, because we're not done, not even close. And here it is. Chris Waller from the Fed now says that the Fed is all in, quote-unquote, re-establishing price stability. You see, the Fed is all about ego. Their credibility is down in the toilet now because they've been singing the tune of transitory for over a year now. And then they said, we're not thinking about raising interest rates. Now, they don't even have the time to think about it. They have to actually just do it Nike's way. And that will come with a lot of risk. So do you have the comfort of buying the dip right now? I don't. It's not just me. It's also the top criminals at BlackRock. Take a look.
I mean, the main point is that we are not buying this dip. Because it's not a dip. It's actually driven by a shift in the fundamentals of the equity market. We've got a higher rate path. We've got now a rising probability of recession in the US, a very high likelihood of recession in Europe at the same time. And as a result, equities don't look cheap to us.
Anyhow, folks, we have to move on here and cover the market information for you. And we start with the performance of indices today. And here we go. The Dow Industrial Average down by 47.12 points, or a decline of 0.15%. The Nasdaq down by 16.22 points, or a decline of 0.15%. The S&P 500 down by 4.90 points, or a decline of 0.13%. The sector's performances were led by number 1, capturing the gold medal, healthcare. Number 2 for the silver, utilities. Number 3 for the bronze, real estate. And the laggards, noticed that yesterday energy rebounded. It was number 1. Now, everybody has the confirmation. They're realizing that the energy trade perhaps is over for now. Take your profits and go home. And therefore, the laggards of the day were led by energy, materials, and technology. The advance to decline ratios, NYSE 41% advancing versus 55% declining. The Nasdaq 48% advancing versus 47% declining. No conclusion here one way or the other, but that's coming, rest assured. Moving on to commodities, and we start with the crash in crude prices. Today marked a continuation of the crash. The WTI is down a little over 1.5%. While Brent down big, over 4% for the day. And please, do yourself a favor and watch the video that I released yesterday. The crash in crude is not an indicator that we're out of the woods, that inflation is peaking, and the Fed is about to cut rates, and everybody's going to live happily ever after. That's a fantasy. The crash in crude marks the beginning of the recession. Watch out here. Meanwhile, the gasoline RBOB was down a little over 1%. And then we have heating oil and natural gas flat, down by about 0.5 percentage point. But look at what happened to natural gas. A massive decline. Just last week, natural gas was trading at almost $10 per BTU. Now we're down to almost $7. That is a massive decline. And I believe that the LNG Freeport facility being down is a factor, but there is another mechanical factor. Go back and watch the video that I produced about the mystery trader who bet a few months ago that natural gas prices will be at $10 per BTU by June. They got that bet right. They scored big. No doubt about it. But I believe that mechanical reason, the squeeze, had a lot to do with the surge in natural gas prices. Now, a lot of folks are confused. If we have a fire that shut down the Freeport LNG facility in Texas, shouldn't that crush the supply and therefore push natural gas prices higher? Not really, because the tailwind behind natural gas moving higher, the fundamental tailwind, not the mechanical one that we just talked about, but the fundamental one, was more demand this time around from the European countries because they're not importing oil and gas from Russia, or at least they're attempting to not import oil and gas from Russia, and they turned instead to the United States for liquefied natural gas, and therefore increasing the demand for the supply that we got. And you saw U.S. natural gas prices moving higher, while European natural gas prices moving down. Now we're seeing the opposite because the Europeans are not going to be able to compete with our domestic supply of natural gas because the facility is down. The export facility is down, the Freeport LNG. That's gone now. So what's going on is U.S. natural gas going down since we have a better demand to supply dynamic, while European gas prices are moving higher now that they have to scramble and find natural gas supplies on their own. And since we're talking about energy, let's talk about some energy news here. A lot of factors are contributing to the drop in crude. Among these factors, the upcoming visit to Saudi Arabia, the potential for a settlement in the Russia-Ukraine war, and of course the upcoming recession. But we have more supply hitting the market right now. For example, the Libyan output is up by 100,000 barrels a day, all the way to 800,000 barrels a day. Now, 100,000 barrels is not going to do anything at all. The Biden administration has been releasing over 1 million barrels a day from the Strategic Petroleum Reserve, and that did not do shit to oil prices. What does that mean? There's another reason why oil prices are down. And my hunch is it is the recession indicators. But since we're talking about crude and gas, here is your Stick It to Putin update. Sticking it to Putin, bruh. Now that the Europeans are, I can't find a better word, but they're to say the least, because the Freeport LNG facility is gone now, at least till the end of 2022. And we, the United States, been egging the Europeans, dump the Russians, don't take Russian natural gas supplies, don't bow down to their demand of paying with rubles, etc., because we got your back. We got all the natural gas in the world. We're going to supply it to you. No problems here. Now the Europeans got caught with their pants down since the Freeport LNG facility is gone, and they have to beg Russia for gas. Again, guess what Russia's doing? Putin is saying, I'm not feeling it. I'm going to cut your gas supplies. He's cutting gas supplies to Germany, to Italy, and many other European countries. And guess what? So much for the sanctions and the embargoes. Let's stick it to Putin. Well, apparently the sanctions are not deterring the the Chinese and the Indians from buying Russian oil and gas. Matter of fact, Russia is now China's biggest oil supplier. And as oil prices continue to linger higher, the Russians are making more money than ever before. And the German minister, the economy minister, who a few weeks ago came out and said, we don't want to be too successful in dumping Russian gas. Now he comes out and says that the fact that Russia is squeezing natural gas imports to Germany, that may trigger the next stage of the country's gas emergency plan. You know what that means? Rationing, austerity measures. Yep, the quality of life of the German population is going to go down. No doubt about it. So these sanctions, these embargoes, they backfired, and they're destroying our economies. Meanwhile, the Russian economy seems to be doing fine, despite all the threats, all the sanctions, and all the stupidity. Now, will the sheepies who've been cheerleading for the sanctions from the get-go and telling me, you don't understand, you're a puppet for Putin, are they going to come out now and apologize and say, hey, bro, you were right all along? I apologize. Of course not, because it's all about ego. That's all there is. Back to the futures, what's going on in softs? We're seeing the rebound in lumber taking a break, but for now, lumber is above $600. Meanwhile, the rally in coffee futures continues to go on. Coffee scoring almost 2% gains today alone. We have muted activities for cocoa futures, while we have declines led by cotton futures. Cotton futures down big in the last few days. Matter of fact, down over 5.25% today alone. We have declines for sugar, down a little over 1.5%, and so did OJ, down a little over 1.5% for the day. What about metals? Muted activities across the board, waiting for the next move by the US dollar. For now, we have no clue at all, but it appears that the dollar wants to move higher. We'll take a look in the charts analysis, but for now, that keeps metals trading muted to the downside. Matter of fact, copper is below $4 now, and palladium is down a little over 1% today. We also have declines for meats across the board, live cattle, feeder cattle, lean hogs futures, all down. And the declines were led by feeder cattle futures, down a little over 1.25%. What about grains? Down across the board, we have muted action for wheat and soybean meal futures, but soybeans, soybean oil, corn, oats, canola, down big, all of them. Corn was down over 9% yesterday alone. Soybean oil down almost 4% today alone. We're seeing that inflation, the air in that bubble getting out. Does that mean peak inflation and it's hunky-dory from this point on? Not really, folks. This is the beginning of the recession. We have seen the same movie before back in 2008. On the other hand, we have rough rice continues to move higher, and today it gained a little over 1%. We talked about the tailwinds for rough rice in a previous video. Moving on to the big casino, the options market, what's going on here? We're seeing elevated options trading activities for Tesla, the souffle, possibly the return of Tesla Whale, who was active yesterday, but it appears that he dumped today, so it was a pump and dump. Yet the volume is amazing for Tesla. We're seeing big bets, both for calls and puts, and therefore the Tesla table came out number one with around 1.1 million contracts traded today for the name. About 52% of those were calls. At number two, Apple, at around 1 million contracts traded today. About 53% of those were calls. At number three, Amazon, at around 850,000 contracts traded for the name today. About 58.5% of those were calls. Moving on to the unusual activities that took place in the options market today. We start with the ticker EWC for the Canadian ETF. I've been positive, bullish on the Canadian ETF, but it appears that everything is falling apart now. Somebody sees that and they're betting for declines to come in the EWC. They bought the $30 puts for the expiration date, December 16th, with expectations that the EWC will be down by more than 11% by then. They paid around 60 cents a piece to enter this trade, all in all spending around $2.6 million. Now, what about the trade for the ticker QQQ, the NASDAQ? We have a put and a call trade. We're going to cover the put trade first. In this case, they bought the 264 puts for the expiration date, June 29th, with expectations that the name could go down by more than 6% by then. They paid around $6 a piece to enter this trade, all in all spending around $5.5 million. What about the trade for the ticker XBI for the biotech ETF? They're buying puts, the 66 puts for the expiration date, July 15th, with expectations the name could go down by more than 8% by then. They paid around $1.65 a piece to enter this trade, all in all spending around $1.3 million. What about the trade for the ticker M for Macy's? I happen to be short the name, bankruptcy in the future, of course, and somebody's bidding for more downside to come from Macy's. They bought the 18.5 bucks puts for the expiration date, July 15th, with expectations that the name could go down by more than 5.5% by then. They paid around 85 cents a piece to enter this trade, all in all spending around $650,000. Here's the call trade for the Qs. They bought the 295 calls for the expiration date, July 8th, and notice the put trade, the expiration date is a little further, July 29th. On the other hand, the call trade is July 8th, so maybe they're betting for a relief rally for a little while, and then a 180 and a resumption of the pain. Anyhow, for this trade, they paid around $2.5 a piece to enter this trade, all in all spending around $1.7 million. At the bottom of the table, what about the ticker REV for Revlon? Now, this is a demonstration of the stupidity of the retail investors. Frankly speaking, what's going on in the stock market right now, the crash, and seeing a lot of retail mom and pops losing their money, the George Carlin in me says, good, let them lose. They're stupid anyways. And I'm talking about these creatures who joined the stock market right after the crash of the Great Panic in 2020. I'm not talking about you and I, the OG retail investors. Because the company announces bankruptcy, and these morons stampede and they buy call options and they buy the stock. The company just announced bankruptcy and they're pumping it higher. I'm done here. All my hopes about retail investors coming together and becoming a powerful force. Forget about all of that. The retail investor, the average retail investor is a dummy. And this is a clear illustration because they continue to buy calls here, betting for more gains for the squeeze. This time around, buying the $9 calls for the expiration date, July 15th, with expectations that the name could go higher by more than 11% by then. They paid around $1.5 a piece to enter this trade, all in all spending around $900,000. Now, when you see that kind of stupidity, you know what you're going to do. You're going to bet the other way. Anyhow, moving on to the heat map analysis, what's going on here? Initially, at least earlier in the morning, we've seen traders dumping the winners year to date, the inflationary trade of energy and materials, and they moved into risk on in technology and communication services and the cyclicals. But that faded away quickly. We're seeing the concentration, the shift is in the defensives. We're talking about the big pharma names. We're talking about utilities. We're talking about REITs. We're talking about consumer staples. And that's about it. These are the ultra defensive names. So what does that say when you got market participants dumping the inflationary trade and not migrating to the risk on trade of technology, communication services, chips, and instead they're migrating to the dividend paying names, the ultra defensive names in big pharma, in real estate, in utilities? This is a defensive formation. Expect predicting more pain to come. We're seeing folks buying bonds all of a sudden. What's going on here? Is this the beginning of the recession? Certainly appears so. But let's talk about individual names, because yesterday Meta was down big and it continues to lag. The reason is Meta got caught by the Justice Department practicing discrimination in housing ads. This is the same company that beats on the drum of diversity this and diversity that every single day. They will take you down if you're not woke enough. But somehow they're practicing discrimination. But of course, the woes for Meta don't stop here. In Russia, they're labeled as an extremist activity company, and the appeal was lost. So they're not removing the title of extremist activity in Facebook, Meta, and this will come with consequences in that country. And of course, today, Mark Zuckerberg was in Jim Cramer, and he was asked about the Sheryl Sandberg scandal, that she was under investigation of abusing the company's resources. And of course, Zuckerberg said, I don't know, you should talk to her. I don't know what's going on. Really? The CEO of the company doesn't know what's going on? I have to talk to an ex-employee? But we also have bad news for Apple. The store in Maryland, I believe, voted to unionize. And this is the first Apple store to unionize in the United States. And breaking news, the iMob of Apple decided to shut down the store. I'm kidding, of course, but that's coming. You know it. And then we have bad news for Netflix, because apparently they lost 2 actors from the series The Chosen One in a van crash in Mexico. Sometimes the jokes write themselves. The Chosen One. Or The Chosen Ones, excuse me. We also have a vote last week for AMC from the Apes. Apparently the Apes are not happy, and they voted against the $19 million pay package for the Silverback, Adam Aaron. Well, apparently the Silverback played you guys like a bunch of donkeys. He got rich, you did not. And now you're mad that he's asking for more. He has the audacity to ask for more. But thankfully, that was shut down right away. And then we have news for the WWE regarding Vince McMahon. We continue to cover this saga. He got caught with a hush payment of $3 million to an ex-employee or a current employee, who knows, who allegedly he had a relationship with. Last Friday, we got the news that Vince is stepping down and his daughter Stephanie is taking over. Now, this is not a major change to any WWE shareholder. It's pretty much the same, but what the shareholders are worried about, what if there is more to come from the scandal? What if we're going to see more beans spilled? And therefore, while the WWE stock is an outperformer year-to-date, beating the S&P 500, we've seen a steep decline in the last few days, and that is due to the lack of confidence that who's to say we're not going to see more of this scandal. And of course, on Friday, on the same day he announced that he's stepping down, Vince McMahon also announced that he's appearing live on SmackDown, and he indeed did. This was perhaps a power move. He did not talk about it, but he was received warmly by the fans, as if he was saying, hey, me too, or whoever attacking me right now, this is not going to land, because I got the wrestling fans all with me. And perhaps it is a move to assure shareholders that he is still in charge. Who knows how this is going to end, but the volatility in the stock is presenting us with a lot of trading opportunities. So we're going to take a look at the WWE stock in the charts analysis. We also got news from Kellogg. They're splitting, not the stock, but the entire company apparently, into 3 companies. A cereal company, a snack company, and a plant-based foods company. All I have to say is, good luck with that. Moving on to the heat map for the ETFs. This is a daily heat map, muted to down activities across the map. No distinguishing between the performance of growth or value, none whatsoever. But we're seeing, of course, energy down big, the XOP, XLE, OIH, all down big, along with the inflationary trade of the XME materials, commodities down big across the board. Yet we're seeing some of the risk-on ETFs, the likes of XPI, moving higher by 2.5% almost. But if that was the case, that we are in risk-on, and there is a rotation out of commodities, out of the inflationary trade, all the way to the risk-on trade, then how come technology and chips did not outperform today? How come small caps, the IWM, did not outperform today? Even international markets were down, no distinguishing between the EWZ, the commodities giant, and the Chinese ETFs. The risk-on indicators, they were all down. And therefore, let's move on to the charts analysis, and we start with the SPY, the S&P 500, 30, minutes chart. Do we have any update from today's activities? Not whatsoever. Why? The pattern for now is a bullish consolidation, a bull flag consolidation for now. But can you trust it? Of course not, at least not me. For me, show me the money. I want to see more. I want to see 385 being captured as support once again. I want to see the gap closed above 385, and then we're talking. But for now, this is within range kind of trading. The support 373.5, the resistance at around 385, and of course, if the support of 373.5 is lost, we have the gap at 368. That would be support number 2. If the chart fails to bounce from that point on, then we have a shorting signal because we got lower lows to visit. Here's the daily chart for the continuous contract for the SPY. What's going on here? Again, within a range, nothing changed here at all. The support at 3,720.5, the resistance at around 3,855. Nothing changed at all. The volume is below average. This is a good sign for the bulls, but the momentum indicators remain negative. And folks, in this bear market, if you're going to buy the dip, the market has to work for you. The market has to show you the money. You have to be more conservative in buying the dips because we're seeing a lot of bull traps. Bull trap after bull trap after bull trap, and the so-called bear market rallies in this bear market are very short-lived. Usually in a bear market, we see bear market rallies that last for a couple of weeks, even months. Not this time around. The bear market rallies last for a day or two and then poof, they're gone. And therefore, you have to be more conservative. In this case, before I buy the dip, I want to see a couple of things. I want to see 3,855 being reassigned as support once again. I want to see the momentum indicators, in this case the MACD, giving me a clear signal that the bearish momentum is over and we're starting new, fresh, bullish momentum in this chart. How would I know that? The answer is if I have a clear, decisive crossing in the MACD indicator producing green impressions on the histogram. And I'm not talking about a peak either. I'm talking about a clear crossing producing big, beautiful green impressions on the histogram of the MACD. Otherwise, I'm not buying. Now, would I short? Yes, I would, but I need to see a couple of things. I need to see 3,720.5 lost the support. Better yet, I want to see how this chart is going to react at around 3,600 as support. If that support is lost, then I'm doubling down and shorting big. Here is the chart of the SPX, the cash index for the SPY. This is a weekly chart. Why am I sharing a weekly chart with you? Here's why. I happen to work with some of the best technical analysts on the planet, in my opinion at least, and they say that they're watching 3,500. They think that 3,500 is the magic number. And they're also watching the 20 weeks moving average, which now coincides with 3,500, which also happens to be the next Fibonacci support. So I'm buying this argument. I'd like to see the SPX going down to 3,500, visiting the 20 weeks moving average, visiting the Fibonacci support, and then if we have a bounce from that point on, I'm buying. But for now, who's to say that what we're seeing right now, the mini rebound that we got on Tuesday, is not going to last. And we will go down another, about 7% before we get to 3,500. Here's the cues. The NASDAQ 30 minutes chart. Again, no update here. Within a range, the support at 274.65, the resistance at 285. Nothing changed here at all. It is a bullish consolidation pattern. The assumption is we have another leg higher, but do you really buy into it? Of course not. At least not me. I'd like to see more. Show me the money. What is show me the money means in this case? Capturing 285 for support and closing the gap above. Now, would I short right now? Of course not. I want to see more. I want to see the next support, which happens to be the gap at 276, being lost without a rebound. I need to see the next support, the actual support, at 274 being lost, and then I'll be comfortable to short. Here's the daily chart for the NASDAQ, the continuous contract. Anything changed here? Of course not. The support, which we marked, by the way, in this channel, about 2 weeks ago, 11,058.5 is holding as support for now, while we have the resistance at around 11,689. For now, the volume is below average. The bulls are going to take that. The momentum indicators remain negative, but we're eyeing a crossing in the MACD indicator. If it happens, we see the support of 11,689 being reclaimed, then we're talking. Perhaps we have a bear market rally, a legitimate bear market rally coming. But without getting the confirmation first, how would you know that? Who's to say that the opposite is not going to happen? We will see the chart losing the support of 11,058.5. If that happens, we have another massive leg down coming. Here's the IWM 30 minutes chart, still within a range. It is a bullish consolidation pattern, but we're not going to buy it right now because we have resistance at around 168.90. We have support at around 164.91. So we're not buying, we're not shorting until one of these two lines is broken. And better yet, if you're going to buy, I want to see the gap being closed, the gap above 168.90. And better yet, I want to see 174.22 being recaptured as support before I feel comfortable buying the dip here. When it comes to shorting, I'm waiting for 164.90 to be lost to support, and that would be an ominous, and I mean ominous signal, not just for the Russell 2000, but for the entirety of the stock market. Why? Because if you zoom out, this is the gap on the daily chart that we talked about. Okay, we got to bounce after closing the gap. In typical charting behavior, if the chart loses that support once again, it is an indicator that we have another massive flush down coming. So watch out for 164.91. The Dixie, the dollar index, what's going on here? A daily chart perspective. The bulls would argue that this is a cup and handle formation, and we have higher highs to come. The bears would argue, not so fast. Watch the momentum indicators. The MACD indicator is about to cross to the downside, producing red impressions on the histogram. And the confirmation would be the Dixie losing 103 as support. So the battle goes on, but who has the better argument for now? I say dollar bulls. If that is the case, then this is not good news for gold. Gold continues to hold on at the support of 1,840, which is around the Fibonacci support, but this is not good. It already made a lower low, and if it loses that support once again, we will see another flush down in gold coming. The next support will be down there at 1,763. What about Brent crude oil from a 4 hours perspective? We're seeing a massive reversal here. The chart lost 118 as support. Not only that, it lost before that the trend line in yellow, and then after that it lost 114 as support. It formed a bear flag pattern, and the bear flag is playing out. We're now watching for 105.84 as the next support, because who's to say that this formation that we got today is nothing mere an ABC pattern. We got the A leg from the bear flag playing out, and then we got the rebound, the reaction, the reflex, the B leg, and now the chart is forming the C leg all the way down to 105.84, if not even below that. Here's the 10-year yield. What's going on here? We talked about 3.5 being as the next psychological resistance, and indeed, it is holding on for now. We have a bear flag pattern. The bear flag is playing out. We have a mini confirmation on the MACD indicator that we indeed have bearish momentum in the chart of the 10-year yield. Now, what does that say from a fundamental perspective? Because the assumption for now, the Fed is going to continue to increase interest rates higher to fight inflation. So why would the 10-year go down? The answer is it is going down for the bad reasons, in my opinion. If it was going down for the good reasons, meaning supply is catching up with demand and the peak inflation theory is playing out, yada, 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 then we should have seen equities moving higher, specifically the risk-on part of the stock market. This was not the case, at least not today. So what this says is the 10-year yield is going down for the bad reasons, meaning the recession. And perhaps it is a leading indicator that at some point the Fed will do a 180 and start cutting rates. Too early for that conversation, but keep that in mind. Next, we have the TLT's chart, a weekly chart. We're getting a beautiful bounce from 109.5. Could this be the beginning of something here? It could, but it has a lot to prove. Show me the money once again. Would like to see great impressions in the histogram of the MACD from a weekly chart perspective. I'd like to see another week, another pop higher. I'd like to see the negative divergence on the RSI from a weekly chart perspective being reversed. I'd like to see the volume picking up higher on the buying side, and then we got a rally in the TLT all the way to 125.12 at least, if not all the way to 128. What about the VIX 4 hours chart? What's going on here? We have negative momentum on the MACD indicator, indicating that the VIX is now bearish, and hence the SPY is bullish, at least for now. The gap of 29.61 produced a bounce. That bounce did not last. Now we're looking down at 27.77. But watch out here of not making the assumption that the VIX is going down and hence the SPY should go higher. Because who's to say that the VIX is not going to bounce from 27.77? We will see a rebound higher, a big one. The negative divergence in the RSI is going to correct, and the MACD indicator will show green impressions in the histogram once again. You're not going to feel comfortable that the SPY is going higher and the VIX is going down until we see a loss in support from 27.77. Likewise, here is the 4 hours chart for the VXN, the VIX for the NASDAQ. While we have baby impressions on the histogram of the MACD indicating bearish momentum in the VXN and hence bullish momentum in the Qs, it is not decisive yet. It becomes decisive once the support of the gap at 32.72 is lost for good. For now, we don't have that yet. keyword yet. What about Apple, the daily chart? What's going on here? Within a range, no update at all. The resistance at around 138.79. The support remains at 127.22. Nothing changed here. What about Tesla, the souffle, 30 minutes chart? What's going on here? We got the pump yesterday. It got us above 700. This is a good sign for Tesla bulls. Tesla whale, of course, is doing the job by buying an insane amount of call options. But did we see the dump part of the pump today? Certainly the bears would argue so, because if we zoom in to a 15 minutes chart, the bears would argue that this is a head and shoulder formation, and soon enough Tesla would lose 700 as support and we will see a flush down all the way to closing the gap. However, Tesla bulls are going to counter and say, if we zoom out to a daily chart perspective, and the daily chart is more significant than the 30 or the 15 minutes chart, we can see a double bottom formation. That will get us above 700 decisively. We will see a relief rally at least all the way to the 900s. And lastly, Bitcoin, what's going on here? The bear flag pattern continues to go on, and if the buyers don't step in and buy Bitcoin, pushing it higher away from the support of 19,500, 550, 20,000, doesn't matter what the exact number is. It is a zone. But if the chart doesn't move away from that zone in the northern direction, then we will see the sellers showing up again, and Bitcoin will lose 20,000. We will see a flush down all the way to 10,000 this time around. When we zoom in to a 30 minutes chart, what do we see here? My number, 19,500, is holding pretty good support and resistance, as you can see from all of these reactions. And since the bottom over the weekend, the bottom for now, of course, we got a trend line, a bullish trend line with multiple reactions. But as soon as yesterday, that bullish trend is now gone, and we have a bearish trend with a sloping line of resistance instead. You can see we have multiple reactions and attempts, at least today, that was met with failure in crossing the line. Now, what Bitcoin bulls are hoping for is a saucer bottoming formation without crossing below 20,000, or in this case, my number, 19,500, and for the chart to move its way above the sloping line of resistance. If that happens, we will see another move higher, another pop higher, and that will get us away from 20,000 in the right direction. And this is what crypto bulls are hoping for. Here is the chart of the WWE. This is a weekly chart. We have a trend line. The name happens to be an outperformer beating the S&P 500 year to date, but for now we have a series of higher lows and the trend line remains intact. Now, so long as the higher lows pattern continues to hold, we see a rebound, a little bit of a rebound, and this will be a good sign that this stock wants to move higher. And any concerns about Vince McMahon leaving the country, or the company, is now behind us. But if the pattern of higher lows is broken, then the confirmation of the trend line being broken too, then you got a shorting signal all the way to the next support at around 40. Lastly, we're moving on to the conclusion of this video. What do we have on the economic calendar tomorrow? We got the initial jobless claims for the week. We also got the manufacturing and services PMIs, and this time around Jerome Powell will be speaking to the Congress, the House. He did speak to the Senate today. We're going to cover all of the testimony by Jerome Powell in tomorrow's video. But for now, this is all I got for you. Thank you for listening. Thank you for watching. I will talk to you again tomorrow.
I'll see you guys around. Stay out of trouble, you crazy kid.